This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in our previous lecture, what we saw was how to put together that income tax computation. We prepared it for an individual taxpayer and we prepared it for a tax year. For us, the 2017-18 tax year, running, as we saw, from the 6th of April 17 to the 5th of April 18. And we listed out on that income tax computation all the sources of taxable income. And we divided those sources of taxable income into up to potentially 3 analysis columns. They were non-savings. Now, what was in non-savings income? Hopefully remember the forms of earned income, employment income and trading income for the self-employed, but also, of course, our property income as well. Over and above that, after listing out non-savings, we followed up with savings income, i.e. interest income, and then finally, if necessary, dividend income. Well, we start this particular session looking at another type of income, exempt income. Now, as you might guess, it's not going to be one of the biggest lists in the world. And the main ones that we need to know about are the ones that you see here at the top of page 6 in your course notes. Different sources of interest mainly. There's, again, 2 main sources of interest here that we'll see which are exempt. You've got to be careful here not to confuse with various others. So here, the main ones that you need to know. Firstly, interest or bonuses they may be referred to on national savings certificates. Now don't worry about what they are, worry about the language. The language there, national savings and investment, this is a government security or type of here, certificates. What you will see as being taxable, and when we come to savings income very soon, you'll see these as examples. You might see national savings and investment, easy for me to say, national savings and investment, sometimes referred to as NS&I, and you might see investment account interest. Investment account interest. That's taxable. It is this certificates here where the exemption applies. So again, watch out for it. In an objective testing question, you could be given 4 different types of income and ask how many of those are either taxable or how many are exempt. And listed in there will be interest, sources of interest income. Be careful, therefore, if you see national savings and investment certificates, it indeed is exempt there. But if you see national savings and investment account interest, that's taxable in the normal way as savings income. Other one here that we see that is going to be exempt, just make a bit more room for that. Interest and dividends within an ISA, an individual savings account. Again, a government-backed product here, individual savings account, to try to encourage taxpayers, individuals, to save rather than to just spend. And they are exempt. Exempt in relation to interest because you could have a cash deposit as an ISA, and also in relation to if you have dividend income. You could have shares and securities placed into such an ISA. Now, again, these are exempt, but as we'll discover soon, when dealing these days, that is since the 16-17 tax year, we've had changes in the taxability of interest income and dividend income, which effectively means for the vast majority of taxpayers that don't actually need an ISA, because some part of your interest income, some significant part of your dividend income will be exempt anyway. I say exempt, it will be covered by a nil rate of taxation, so it will not be chargeable to tax. So in which case, these are not as popular as maybe once they were. Plus, of course, with interest rates the way that they are, not going to be very popular either for that reason. But watch out for those. Those are exempt. Again, the typical question within an objective testing, an OT question there, listing out either how many of these are taxable, how many are exempt. Watch out in relation to those two. Especially there, watch out for national savings certificates as compared to national savings and investment account interest. Finally there, winnings. Gaming, lottery, premium bond, that's again An investment you can make, it doesn't earn any interest, but every month there's a draw and you might win some money in relation to it. Another government-backed investment scheme, or at least savings scheme there. But again, gaming, lottery, betting winnings are not going to be taxable. If they were going to be taxable, then of course they'd have to allow losses. And what do most people do when they bet? They lose, of course. So they're not going to be taxing winnings, only then to have to allow losses. So those, again, are exempt sources of income. Might be tested in a written question in section C, but far more likely to be involved within an objective testing question where you're sorting out which are going to be taxable and which are going to be exempt sources of income. Then we come to the main object of this, and indeed some future lectures carrying on from this one as well. And that's, having got your taxable income in our first part of the computation, remember how there were two parts. Calculate your taxable income first of all. Now we need to calculate the amount of tax that is chargeable thereon. And there's two figures of tax that we need to look out for and to read very carefully as a requirement in a question. Do they want just the first figure that will compute the tax liability, or do we need to move on from there and also compute, or instead compute, the tax payable? So, having got our taxable income in the first part of the computation, now it's about computing tax liability and or tax payable. Tax liability, simply the amount of income tax that is chargeable on our taxable income. What we'll discover in a moment's time is, depending on the type of income, non-savings, savings and dividend income, there will be different tax rates that apply. Not just due to the type of income that it is, but also due to the amount of income that you have. This is a progressive form of taxation that you'd have read about if you've looked at it as yet in Chapter 1. It's a progressive form of tax, i.e. the higher your income goes, the higher the tax rate that you pay. We'll see very soon that we've got three recognised tax bands. We have a basic rate tax band, we then move up to a higher rate tax band, and finally we have an additional rate band. If you've got lots of taxable income, that is, I would hasten to add. So there are these differing factors that may impact upon the specific tax rate to apply to any part of your taxable income. How much income do you have in total? Are you just a basic rate, or do you move to higher rate, or do you even become an additional rate taxpayer? But within that, what type of income? Is it non-savings? Is it savings? Is it dividend income? So the tax liability, we apply the relevant tax rates to the relevant type of income and compute that tax liability. As it says here, it's necessary to take each part of the taxable income in order. Again, one of the reasons why we had to use those columns. We will tax firstly non-savings income, followed by savings income, and then finally dividend income. That will be the running order in which we compute our tax liability and go on then to compute, if necessary, our tax payable figure. Tax payable, all that is your tax liability less any tax already deducted at source. And what that will equate to, so far as our syllabus at least is concerned, is just one thing: pay as you earn. PAYE, you may remember we mentioned this in relation to our earlier lecture, and that was what is charged and deducted at source by employers on employees' employment income. So only if they ask for tax payable will the PAYE need to be deducted. Otherwise, tax liability is before that deduction. Again, important in terms of interpreting the objective testing questions, where it's so easy to make a mistake by getting an answer which of course is on your choice of 4, but it's not the one they wanted. Read those questions, the specific requirement, carefully. Right, so at the end of the previous session we had determined not just a total taxable income, but an analysis of that. How much of it was non-savings, how much, if any, was savings, and thereafter dividend income. So what now about the tax rates on the non-savings income? Well, this is going to be as easy as it gets. We have here the three rates that we referred to earlier: basic rate, thereafter higher rate, and additional rate. And we have bands in relation to these levels of tax rates. The basic rate band goes up to a taxable income figure of £33,500. And the basic rate of tax that we pay is 20%. Go above £33,500 worth of taxable income and it gets a whole lot more serious, because the higher rate is twice the basic rate. It's 40% there, a significant amount of tax. And that higher rate band is then to be used in relation to non-savings taxable income above £33,500 and up to £150,000. Now that's a very much bigger band than is the basic rate band. But if you go above £150,000 worth of taxable income, you become an additional rate taxpayer, and on that excess, 45%. So we pay these tax rates within the band. The first £33,500 will be taxed at 20%. We then progress this progressive form of tax, that your taxable income above £33,500 and up to £150,000, within that band, it's taxed at 40%. Go above £150,000 and that excess above £150,000, all of it, there's no limit thereafter, will be taxed at 45%. Now we know what the non-savings income is made up of. As we saw last time, it's mostly to do with earned income, whether that's your trading profit or whether that is your employment income there, two forms of earned income that we have, or indeed property income. Now, we are just expressing here how it is we calculate the tax on a given figure of such income, be it trading profit, be it employment income, be it property income. What we'll have to see in all these various chapters here is how it is that we derive those figures of income that will be chargeable to tax to include upon the income tax computation, as we saw last time. That's going to be a problem. Look at trading profit, chapters 4 to 8. There's some 5 chapters there that deal with trading profit. What they look at is, to begin with, how do we take what is an accounting profit and turn it into a taxable profit? It's an adjustment. We calculate a tax-adjusted trading profit. There are expenses, for example, debited upon your accounting profit figure, your statement of profit or loss, but which are not allowable for taxation purposes. In Chapter 4, we look at that process of adjustment of profits. And probably the most well-tested and probably the one and only one that you'll remember until your dying day here, sad to say, in relation to non-allowable expenses, is depreciation. Now you know that depreciation is simply, in accounting terms, writing off the cost of an asset used in the trade over its useful economic life. And there's absolutely nothing wrong with that as an expense for accounting purposes. But for taxation, no, that will be disallowed. We will add it back to our net profit from the accounts. Notice we talk about an adjustment of profit there, as you'll see in Chapter 4, so don't worry about it again now. But in Chapter 4, we will not produce an entirely new taxation P&L account. What we do, we take the profit worked for accounting purposes, your bottom line net profit, and we adjust it for taxation. So if there have been expenses deducted in deriving the accounting profit, making the profit smaller as a result of that deduction, but that they are not allowable for taxation, for example depreciation, then the adjustment will be to add that back as a non-allowable expense, thus increasing the amount of profit that is then chargeable to tax. Now again, you may consider it's rather odd that debit is perfectly fine for accounting. Why do Her Majesty's Revenue and Customs insist that we disallow that? For one very good reason, that is because with depreciation policies, you can have just about anything you like. Any percentage you pick, any method you choose, straight line, reducing balance there, and over however many years that you choose. It's way too flexible. So what they have done at HMRC is not to disadvantage us, but to replace the deduction of depreciation with the deduction known as capital allowances. Chapter 5 deals with capital allowances. It is the way in which we gain tax relief for capital expenditure incurred within our accounting period. So yes, we do get tax relief for capital expenditure when it is on qualifying plant and machinery, as we'll see in Chapter 5, in the form of capital allowances. Put those two exercises together, Chapter 4 and Chapter 5, and what you've got is a tax-adjusted trading profit for an accounting period. But then we have a problem. A trader may choose to prepare his or her accounts to any accounting date they wish. Traders do not have to prepare accounts, every one of them, for a year ended 5th of April, i.e., with any choice of accounting date, how do we relate any accounting period to a tax year? A tax year that is a very given time period, very specific, 6th of April to 5th of April. In Chapter 6, we look at the main basis of assessment that applies there. We won't worry you about it now, but we'll see that in applying that basis there are special rules to deal with special problems of when businesses first start to trade or when businesses cease to trade. So there's some quite complicated there bases of assessment that will need to be learned in relation to trading profit. Students don't like learning those rules, but they will need to be learned. I'll take you through them, I'll show you how we deal with it, but they will need to be learned by your good selves there. But that awaits you in Chapter 6. We mentioned last time when we looked at the income tax computation that instead of having a trading profit, sadly, you might have a trading loss. In which case, what did you do? Well, what did you record on the income tax computation where the tax-adjusted trading income figure turned out to be a loss there? Well, what do? We put in a nil assessment. We didn't put a bracket in, we didn't put a negative figure in. And then there were a variety of loss reliefs that were available. We looked at two of those. If you inherited a brought forward trading loss coming into this tax year, you would then set that automatically off against the trading income of this period. If you made a loss in this tax year, you could, if you so chose, set it off against the total income of the year. Go back and remind yourself on that pro forma computation, look at where those loss reliefs came in. Well, Chapter 7, as I promised you that time, is where we deal with all of the different loss reliefs and the different circumstances in which we may have to deal with such losses being sustained by a trader. In Chapter 8, what we look at, there's another chapter here dealing with trading income, we look at partnerships. Because when dealing with unincorporated traders are individuals who've set up in business. To begin with, we may think that, well, we know how to deal with a sole trader, an individual, but not all unincorporated trades are just one person running his or her business. We could have two or more persons, partners in a partnership, and in which case, how do we deal with them? What we'll discover there is that most of what we've previously done, the adjustment of profits, the capital allowances, are done the same for a partnership as we do for a sole trader. And we calculate the tax-adjusted trading profit of the business, as we would for a sole trader. But what have we then got to do? We don't tax the partnership, we tax the individual partners on their share of those profits. So what have we got to do? We've got to divide those profits between the partners. How do we do it? According to the profit sharing agreement in force during the accounting period. That awaits us in Chapter 8. Equally, if a partnership makes a loss, we need to share that loss out amongst the partners, and then each partner is free and able to make their own decision about which of the available loss reliefs they would choose to take. But again, there very quickly is 5 chapters that we'll be looking at, and there will be much to say about each of those areas. So again, we cross those bridges when we come to them. Employment income, just one chapter, Chapter 9, but a big one. And as I said to you in that first lecture on this chapter, it's a very important one as well. Something on employment income in one part or other of the paper will be involved. Property income in Chapter 3 Having dealt with the details of the income tax computation and its content, how to establish taxable income in its different forms, how to then tax that taxable income, we then start to look at the detail. And property income, we'll also look at dividend and a bit more at savings income indeed in Chapter 3, or sources of investment income. We'll deal with that there. But at the moment, assuming that we are given a figure of income, whether it's non-savings, savings or dividend, how do we tax it on the income tax computation? Well, here we go. Example 1 to begin with. Again, read the requirement carefully. Here, calculate the income tax payable by the taxpayer. It's not liability, payable. What does that mean? We're going to be dealing with an employee who has employment income, and against that employment income, PAYE has been deducted by his or her employer. So it is unsurprising as we read the question that Mr. Smith has been working for many years, received a salary of £50,500 per annum. At least that is the figure for our tax year 2017-18. And on that salary, PAYE has been deducted by the employer, amounting to £8,000. So what will it mean? To calculate income tax payable, we need to firstly compute income tax liability. We'll then deduct that £8,000 to bring us down to the income tax payable figure. He has no other sources of taxable income. So a very basic example here to begin with. Right, what do we need to do? We need to determine, of course, the different types of income in analysis terms that we have. A salary of £50,000 there, £500. A salary. That is non-savings income. It's the only source of income. So if we were doing our full pro forma for this, we would have non-savings income. There's no savings income, there's no dividend income, so we do not need those columns. So all we'll then need is a total column. That's all we will require. Also note what it says here about the salary received. Now we'll look at the details of this as we said in Chapter 9, but yes, on employment income, a very basic system, basis of assessment applies. Again, actual amounts received there. We've got to calculate the tax liability to begin with, therefore, on that salary figure. So away we go with our computation. Salary or employment income. Again, will not matter what term you use there. How much do we have received in the tax year? £50,500. In it goes into its analysis column, and of course then everything goes into the total column. If we had sources of savings or dividend income, we'd have had those columns set up and we'd then proceed to list out. In terms of how you list this income out, follow the pro forma, deal with earned income before unearned income. That would then come down to a figure of total income, which was also here a figure of net income. There's no deductions here from the total income to give you net income. There's nothing to add through, so it's not necessary for me to put in a total income figure. That is it, 50,500. But away from that, we get to deduct our personal allowance. Now again, on your rates and allowances, it would be useful, by the way, if you haven't already, from now on as we go through these examples, have at least from your tax rates and allowances pages the income tax information. It will tell you the level of personal allowance, that is £11,500 for our particular tax year, which we deduct again from non-savings and from total income. Remember, if we had got those other sources of income, savings and dividend, it is the non-savings income that will have the personal allowance allocated to it first of all. There is that order of setup. Firstly from non-savings, then if relevant from savings, and only finally then a deduction from dividend income. Here, of course, there is only non-savings. And when we deduct the personal allowance from what now would be our net income, it gives us our taxable income. If I can make the pen work. There we go. taxable income. So we take it away, our 11,500, and of course when we take that away, I think that will give us, but make sure you've got your calculators ready and you use them, down to methinks £39,000. Having got the taxable income, then we proceed to tax that taxable income. Always, first of all, non-savings income. It's the only income here. But again, if you've got more savings and dividend income, you must do it in this order. Now we've got here taxable income of 39,000. Just go back for one moment and look there at your rates of tax applicable to non-savings income. And what do we see? We see there that we have got, let's just scroll that back for a moment, 20% basic rate band, and that only goes to £33,500. So here, therefore, in terms of our calculation of tax, all of the basic rate band will be used, 33,500 times 20%. Now we're taxing in total £39,000. So some of that non-savings income has gone up into higher rate. So 39,000 is the taxable income. Take away what we've already computed or shown as chargeable to basic rate tax, that's the 33.5, and I think that will leave you with £5,500, and that then will be taxed at 40%. It's then calculator time, work out those tax figures, and that then will bring you down to, once you've got those numbers, your tax liability. So you add your basic rate and your higher rate together and you get your tax liability. But the question didn't ask for tax liability, it asked for tax payable. So what do we need to do? We need to deduct our income tax that has already been deducted at source. That was on the PAYE system. PAYE. Back to the question, how much did we have? We had £8,000. So that will be deducted in deriving your tax payable figure. Okay, what I'd like you to do, you can use a calculator as much as I can, probably better indeed there, and probably a whole lot more quickly as well. Work out the figure, check out the answer in the back there, the example answers you will find, and again then, make sure for next time when we continue on from here and do rather more interesting calculations of different types of income, more amounts of income, savings income, particularly interesting if you'll pardon the pun. But make sure you're happy with what we've done, check out that answer, and then we'll move on in our next lecture together.